If your only plan for making money is trading time for a paycheck, you're signing up for a grind that never actually stops. People often assume paying off their house is the finish line, but a primary home doesn't generate income. To extract the wealth trapped in your walls, you have to sell the house, leaving you without a place to live. Then there's the standard 401k. It's a tool for preservation, but it's built on a rigid timeline. It locks your capital behind strict rules and penalties, purposely keeping it out of your hands until you hit traditional retirement age. If you want to step off the treadmill early, you have to replace your active salary with assets that generate consistent cash. Building that portfolio from scratch requires heavy front-loaded effort. This matrix compares the two paths side by side. The traditional route relies on a paid-off house and a 401k for later years. The financial independence route uses cash-flowing assets and tax strategies to buy back your time right now, allocating capital into 5 distinct asset classes. Your choice depends entirely on the capital and bandwidth you have right now. Early freedom depends on the math of your situation. You succeed when you align your specific hours and capital with the asset class designed to handle that load. Let's look at this chart weighing active time required against yield and tax efficiency. In the top right corner, we plot your business and real estate. These offer highest returns, but demand the maximum amount of your time. These are heavy lifts. You are dealing with hundreds of operational hours, hiring and managing employees, and handling tenant liabilities. It operates exactly like a second job. The operational risk is high. A single lawsuit, a bad hire, or an economic shift can expose how fragile a new operation really is. But if you navigate those risks, these assets produce consistent, reliable cash flow every single month. They put money directly into your checking account to pay your bills so you don't have to clock in. They also come with deep tax advantages. Real estate investors use a legal code called accelerated depreciation to tell the IRS their property is losing value on paper, lowering their taxable income even while the property pulls a profit. Then there's the 1031 exchange. If you sell a profitable property, you can take all of that gain and roll it directly into a larger property without paying a single penny in taxes at the time of the sale. Business and real estate build wealth faster than anything else. But because of the intense operational friction, they are difficult options if you are already stretched thin on time. If you can't afford to take on a second job managing properties or employees, you have to look at the stock market. It is highly scalable and requires a fraction of the physical effort. The lowest friction route is passive investing through broad index funds. When you buy a fund tracking the S&P 500, you are purchasing small slices of the 500 largest companies in the market all at once. You execute this with a strategy called always be buying. You set up an automated transfer so money leaves your checking account every month, requiring exactly 0 hours of maintenance on your part. These funds are self-cleansing. If a massive company mismanages its business and goes bankrupt, the fund automatically kicks that company out and replaces it with a growing one without you lifting a finger. The trade-off is that you surrender the chance for massive overnight gains. You also face capital gains taxes when you eventually sell, which drags down your compounding over time compared to real estate loopholes.
You can try to beat those average returns by becoming an active investor. But this means you have to consistently research macroeconomic trends and identify where money is moving before the rest of the market catches on. For example, tracking the aging population in the United States and calculating how that demographic shift will funnel capital into the healthcare industry long before it makes the mainstream news. Passive index funds secure baseline market returns for zero effort. Active stop kicking requires a massive time commitment and carries the very real risk that you might actually underperform the baseline anyway. Beyond the core pillars, you have the fringe assets, speculative investments like crypto and startups, and hard money like physical gold. These require a strict boundary. They should only ever hold a small minority percentage of your capital, and you should only fund them after your primary income streams are already stable. Speculative markets are highly volatile. You are strapping into an asset class that can drop straight into the unknown at a moment's notice. The mathematical reason to endure that volatility is the chance for asymmetric returns. If a startup you back actually succeeds, the multiple on your money can be enormous. Physical gold serves a specific defensive purpose. It protects historical purchasing power against inflation rather than multiplying your wealth through growth. But gold has a major mechanical flaw. It doesn't build a product, it doesn't generate a profit, and produces zero cash flow. It just sits in a drawer. Speculative assets are calculated lottery tickets, and gold is doomsday insurance. Neither has the mechanics to reliably replace your 9-to-5 salary. True diversification requires ownership across disconnected asset classes: stocks, real estate, and hard money. Owning 6 different mutual funds offers little protection if the entire stock market takes a hit. These assets operate on entirely separate economic cycles. In a downturn, the stock market might crater while real estate prices continue to climb, or vice versa. Holding different asset classes protects your portfolio from a total wipeout during those dips. Surviving those cycles is what allows compound interest to run its course without catastrophic interruptions. The power of uninterrupted growth is why Einstein reportedly called compound interest the 8th wonder of the world. Those who understand it earn it. Constructing a system that spans different cycles protects your principal from being wiped out. This allows compound interest to work over decades, moving your progress forward even when one specific market hits a wall. This scorecard lays out exactly where you should start, based entirely on your current constraints. If you are the beginner with low capital, avoid real estate. Focus entirely on maximizing your career income and automate small, weekly contributions into passive index funds. If you are the time-poor professional with high capital but zero free time, stick to passive stocks and consider working with a vetted fiduciary. This lets you maximize tax efficiency without dealing with landlord headaches. If you are the aggressive optimizer with high energy and a high tolerance for risk, you want business or real estate. You accept the severe operational friction in exchange for maximum cash flow and tax loopholes. Financial independence is built sequentially. Pick the one pillar that actually matches your reality today, master it entirely, and do not move on to the next until that engine runs on its own.